after lunch and so on. I'd like to talk a little bit about a different topic, the topic of market structure and how it's been changing the business realities for market participants, the industry structure we're talking about. I'm not talking for budding quants in the organisation, in the audience who might be talking about market structure, I'm talking about the industry role, the focus on the stakeholders in the industry, and the not so quiet revolution that has been happening over the past 10 or 15 years, past decade or so. If I position the business realities for these folk, then I hope it'll help you position the skills and that you're picking up and the way you might position yourselves in the new industry reality. So I was asked to define capital markets terms buy side and sell side because they're oft used and people have various different interpretations of them. The erudite MarketsWiki, thank you John, has good definitions of it, so does Wikipedia, Investopedia and all those sorts of things. But they're pretty traditional and they're pretty dry. For me, my definitions, the buy side focus on the asset managers, the pension funds, the insurance companies, all those who are investing in the markets and taking risk, okay? And they are serviced by the sell side who are providing customers products and services from that. The sell side, traditional banks, prime brokerages, investment banks, and also non-bank FCMs. For those that don't know all the TLAs in the industry, three-letter acronyms, FCM stands for Futures Commission Merchant. It's a broker-dealer. These guys provide a bundle of products and services. We're talking about execution, research, leverage on the balance sheet, loan, financing, liquidity to the marketplace. And that bundle of products and services is quite extensive. Now I can't talk about all of that throughout the definition of the sell side today. So what I'd like you to take away is the fundamental thing that the sell side does is it facilitates access to markets and develops this bundle of products. Now there's two major forces that have been acting upon the industry in the past decade or even a little bit longer. These two forces are unbundling. Okay, now unbundling happens as a consequence sometimes of regulation, but often also as a consequence of competition. So these product sets are being unbundled. The second major force that's happening in the marketplace is fragmentation. We have an awful lot of liquidity pools. We have, as per David's talk earlier, lots of new entrants, new exchanges, new lit and dark pools, all offering products and services and variants and fragmenting that liquidity across the globe. So starting with unbundling. It's often spoken in terms of regulation. MiFID II, everybody has heard probably of MiFID II, and where the regulators have said that execution and research functions need to be separated and separately paid for. That's all okay. But actually unbundling goes a lot further than that, and it started a lot earlier than MiFID II, which is only fairly recent. If you cast your mind back post the global financial crisis in 2008, most investment banks had significant proprietary trading businesses internalised, so little buy sides internalised inside the bank, taking risk, playing with the bank's money, and making profits. Post-GFC, we've heard of Volcker and Vickers. I'm going to use a lot of terms you can look up on Investopedia or Wikipedia. Volcker and Vickers came along and said the banks had to place these groups outside of the traditional bank. This removed a profit centre that the banks were reliant upon to cross-subsidise some of the execution and other functions that they actually provided the buy side routinely. Other forms of unbundling, Basel III coming up. Banks are required to hold more capital on the balance sheet and to take on less leverage, ostensibly, and it's true, to protect the integrity of the financial market. Consequence, capital scarce. Banks are unbundling now customers that no longer fit their profitability criteria. Whole customer bases are moving about to different suppliers and finding they just don't have a home at all. And the banks are also looking more closely at where they commit that scarce capital that they have on their balance sheet and looking carefully at the risk taking services, liquidity, market-making services they provide. So before your eyes glaze over, and there's another talk on regulation, which we don't want, unbundling is a natural consequence of just plain old competition. So likewise, the trend to unbundle technology packages that the sell side has traditionally provided the buy side is happening. The race to zero latency, we've all been talking about over the past few years, and the need to reduce costs means that the sell side's unbundling that whole technology stack. My company, Object Trading, is a good example of that. We provide a buy-side and broker-neutral independent infrastructure for accessing world markets. So moving on from unbundling, the fragmentation concept. It's a simple concept. It's simply competition. There are a vast number of new liquidity pools, vast number of products and services that, whether they're me too or whether they're innovative, is in the eye of the beholder, but that are certainly competing for attention and competing for the liquidity that's available in the marketplace. And as we said, capital is very scarce. This is causing buy sides and sell sides increased distribution and access problems. The heavy fragmentation in the marketplace across all these vast new products and destinations is making it harder and costlier for the buy side to invest and the sell side to provide that bundle of services they need for the buy side to access the markets. So what's this mean for the buy side, sell side relationship? Firstly, market making liquidity provision. Traditionally a function of the sell side, the big banks, is starting to transition to the buy side. There's a whole new breed of buy side or principal trading groups who are investing significant capital that they have available to them in non-banks to address parts of the banking business that aren't addressed any longer by the banks and aren't profitable to be addressed. Names such as Optiva, KCG, DRW, lots of these companies have spoken in this series before, are all examples where they're taking risk and they're applying their capital as the bank's capital and market-making activities are starting to evaporate. And this is a really important function for a good, efficient marketplace. We've got to have that liquidity provision, especially in times of stress. So we're seeing a transition from sell side to buy side. Brokers are being more selective on the customers they can service. Buy sides are finding it harder to maintain a relationship with a single broker, and they're having multiple brokers, and they're having to find multiple targets to be able to get them to the wide range of pools that they need to seek alpha these days. The counterpoint for all of this for the buy side actually is that the buy side has to try to make itself attractive to the sell side these days. There's a turn up for the books. They've got to think, is their execution and clearing and what they're asking of the sell side an attractive, profitable transaction for their sell side service partner? Furthermore, they're taking on fintech themselves, the buy side, and market access technologies to try and make themselves a reduced cost proposition for the sell side to service. The race to zero originally was all about needing to manage risk and cost. Now for the buy side, it's a search for liquidity across fragmented pools. Sell side is less a source of fintech these days. And in fact, exchanges themselves see themselves as fintech providers. Further blurring the landscape is that big buy sides are now starting to provide fintech and regtech, new term, regulation technology, to their brethren. So we're seeing a real blurring of the landscape there. Don't worry, that doesn't mean that a career on the sell side, especially if you're a technologist, isn't very rewarding. They haven't given up on technology, but what they are doing is having a laser focus on what they apply those resources to. Things like advanced execution, analytics, data analytics, all those things where they can value add for the buy side customer is where they're willing to spend their cash these days. So with so much change in the traditional roles, buy side and sell side, what's it mean for them and what's it mean for you seeking a career? The buy side sell side relationship is unlikely to get any clearer. It's going to further blur over time. The clarity of the past is well gone, and so we've got to get used to the idea of it being a very malleable industry. The market needs to adapt. It needs to form new relationships very, very efficiently and very quickly, much faster than it's done ever before. And flexibility is the key. So if I've got one piece of career advice for you folk, mirror the industry's need for flexibility. I think the millennial generation is very well set up to be very flexible. But I think my advice would be stay technical for longer. Learn the ropes, preferably across a vast range of different roles, perhaps in buy sides and sell sides. I was very lucky to have a career that spanned a number of different institutions and a wide range of roles, which gives a good perspective for driving innovation. The key to continuing relevance and an exciting career is flexibility. The good news for you, okay, David said there are perhaps less numbers of roles. However, there's even more competition, especially for mathematicians, for technologists, for business talent that can be adaptable and very flexible. Okay. Oh, the reference to Trading Places, the movie. I don't know if you noticed it in the title. Most of you weren't even born in 1983. It stars Eddie Murphy and Dan Aykroyd. I hope you know those guys. They're still out there and still beating. It's set in a commodity brokerage in Philadelphia with a wily investor and a street smart con artist. And actually there's some millionaires behind them who decide to swap their roles and see what panic happens. So it's a great metaphor for the changing buy-side and industry relationships, wrapped in a comedy about futures trading. I think it's great light relief, and you can probably find it on Netflix. Okay, thank you.